If you think your credit score is a reward for being responsible, that's why it feels confusing, because your credit score isn't a grade. It's a risk meter. It's a number designed to predict one thing: how likely you are to pay bills on time. And once you see it that way, the rules finally make sense. In this video, I'll show you the 5 things that actually move your score, and the popular advice that does almost nothing. Quick note, this video is for educational and entertainment purposes only. I'm not a financial advisor, CPA, or attorney, and this isn't financial, legal, or tax advice. Full disclaimer is in the description. All right, let's make this practical. Meet Lisa. She's working a normal job. She's paying bills. She's trying to get her score up because she wants better rates. But her score keeps moving around, and she has no idea why. So here's a promise. By the end of this video, you'll know exactly what moves a credit score and what's mostly noise. A credit score isn't measuring your income. It's not measuring how smart you are. And it's not measuring your net worth. It's measuring risk based on what shows up on your credit report. Think of it like this. A lender is asking, if I lend Lisa money today, how likely am I to get paid back on time? That's it. And for most score models, scores run from 300 to 850. So if you've ever wondered what's good is usually around the 670 range and up, and the national average is in the 700s. Credit scores move mainly because of 5 things: payment history, utilization, age of a credit, new credit and inquiries, and credit mix. We'll hit each one, and I'll tell you exactly what helps and what doesn't. First, payment history. This is the biggest one because it answers the core question: do you consistently pay on time? And here's what most people misunderstand. A payment that's 1 day late can cost you fees, but it usually doesn't hit your credit report. The big damage starts when it becomes 30 days late, because that's when it can be reported. So for Lisa, the number one job is simple: never miss a payment by 30 days. That's why Autopay is powerful. Not because it gives you points, but because it prevents mistakes. Quick rule: set Autopay for at least the minimum, then pay extra manually when you can. Second, utilization. This is the one that makes people say, I paid on time. Why did my score drop? Utilization means how much of your credit limit you're using. If Lisa has a $5,000 limit and she's carrying a $2,500 balance, that's 50% utilization. And most of the time, lower looks safer to the scoring system. Now here's the key timeline. Your due date protects your payment history, but your statement close date controls what balance gets reported. So if Lisa wants her score to look better fast, she doesn't just pay by the due date. She pays the balance down before the statement closes. So the reported balance is smaller. And one more myth. You do not need to carry a balance, and you do not need to pay interest to build credit. The best scores tend to show very low utilization. Single digits is the sweet spot. If that feels hard, a practical target is under 30%, and then keep pushing gut lower over time. Also, 0% utilization doesn't give extra benefit. Very low is fine. The goal is low and stable. Third, age of credit. This is the slow one. It builds in the background. The scoring system likes to see a longer track record. Older accounts can help because they show stability over time. So here's the common mistake. Lisa pays off a card, and then she closes it because she wants to be done with it. And sometimes that's fine. But closing a card can backfire in 2 ways. 1, it can reduce her total available credit, which can push utilization up. And 2, it can eventually reduce the average age of her active credit profile. Important detail. Closed accounts in good standing can stay on your report for years, so the impact isn't always immediate. Here's a practical rule. Don't close old cards just to close them. If there's no annual fee, keeping it open often helps more than it hurts. And if you're worried you'll use it, lock it down. Remove it from your wallet, purse, or phone, delete it from saved payments, and keep it in a safe place at home. Fourth, new credit and inquiries. This is where people get scared for no reason. 2 quick definitions. A soft inquiry is when you check your own score or when you get pre-qualified. That usually does not hurt your score. A hard inquiry is when you apply for new credit. That can cause a small, temporary dip. In many cases, it's around 5 points or less, and it tends to fade over time. The bigger problem isn't one inquiry. It's multiple applications close together. And if Lisa is rate shopping for a car or a mortgage, those inquiries can often be grouped if done in a short window. Here's another practical rule. Batch your shopping. Don't apply randomly. Fifth, credit mix. This is the smallest one for most people. It just means, do you have experience with different types of credit, like revolving credit and installment loans? But here's the trap. Do not take out debt just to improve your mix. If you already have a credit card and a car loan, your mix is basically fine. Focus on the big ones first. Now let's clean up the most common myths. Myth 1, you have to carry a balance to build credit. No, paying interest isn't a credit building strategy. Myth 2, your income affects your score. Income doesn't directly affect your credit score, but lenders still look at income when deciding whether to approve you, what limit to give you, and what terms you get. Myth 3, checking your own score hurts it. Checking your own score is typically a soft pull. That's not the problem. Myth 4, if you're debt-free, you automatically have a perfect score. Not always, because scores reward an active, healthy credit profile, not just zero debt. Myth 5, closing a card helps your score. Sometimes it can, but often it hurts by raising utilization. Myth 6, one hard inquiry ruins your score. Usually it's small and temporary. And myth 7, there is one single credit score. You actually have a family of scores, different bureaus, different models, different versions, so the number can change depending on who's looking and when. So what should Lisa actually do starting this week? Here's a simple 30-day plan. Step 1, protect payment history. Set autopay for the minimum on every card and loan. Step 2, attack utilization. Pick one card and pay it down before the statement close date. Even a partial paydown can change what gets reported. Step 3, don't open new accounts unless you have a clear reason. No random store cards, no just-in-case applications. Step 4, don't close your oldest no-fee card. If it's safe and manageable, keep it alive. And Step 5, check your credit report for errors because you can't fix what you don't see. If Lisa does just those things, she's working with the scoring system instead of fighting it. Here's the rule to remember. Payment history builds trust over time. Utilization moves your score fast. Everything else matters, but those two do the heavy lifting. And if you want, in the next video I can show you how to raise your score faster without adding new debt. Just let me know in the comments below. If you want more deep dive, no fluff content on money, freedom, and designing your life, explore the other videos on the channel. And if you want to go deeper than we can in a single video and actually follow a strategy to improve your financial situation, I put everything into a book so you can apply this step by step. It's called Fire Movement. Stop trading time for money and build freedom. A finance guide and workbook to financial independence and retiring early. It's practical, it's structured, and it's built to turn fire from an idea into a plan you can follow. Inside, you'll find worksheets to dial in your numbers, clear action steps so you're not guessing, and quick quizzes to make sure it clicked. There are also real-life scripts, like asking for a raise and having money conversations without freezing up, and step-by-step tools for reducing debt, tightening your budget without feeling miserable, and sticking to a system long enough to see results. So if you're ready to move from I get it to I'm doing it, grab the book. The link is in the description. And if this video helped you, hit like, subscribe, and share it with someone who needs to hear this. Thanks for your time.